Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
All right, everybody, this is the Northbound Wealth Podcast, January 20th. It is Tuesday, the day after Martin Luther King Day. And this is your weekly market insights. Jay Powell, keeps cool in the hot seat. That's the headline this week. Stocks ended last week with modest losses after a volatile 5 days of market-moving economic data, geopolitics, and Fed drama. Last week, several big banks began their quarterly earnings season with weaker than expected revenue. The Standard & Poor's S&P 500 index slid 0.38% and ended Friday's session at 6,940.01. Despite the slight weekly drop, the market benchmark is up 1.4% this month. The NASDAQ Composite Index skidded 0.66%, closing the week at 23,515.39. The Dow Jones Industrial Average edged down 0.29%, closing the week at 49,359.33. By contrast, the MSCI EAFE Index, which tracks developed overseas stock markets, rose 1.41%. Choppy trading, and it looks like it's continuing this week. After the holiday, we're selling off a little bit here due to Greenland news and Davos news from Trump there speaking. Stocks started the week lower after pre-opening bell news that the Justice Department had launched a criminal investigation into Federal Reserve Jerome Powell, and a statement issued Tuesday morning by central bankers worldwide helped tamp down market volatility. The president backtracked on his preferred candidate to be the next Fed chair. His comments led investors to believe that his new choice would be more market-friendly, but perhaps less likely to adjust interest rates. The White House called for a 10% cap on credit card interest rates for 1 year, putting pressure on financial stocks. Meanwhile, news that headline inflation matched forecasts while core inflation came in cooler than expected was well received by investors. Despite solid retail sales and wholesale inflation reports for November, stocks were under pressure on Wednesday due to geopolitical tensions and disappointing fourth quarter results from a handful of financial stocks. Those being JP Morgan Chase, Wells Fargo, and Citigroup were among the banks that disappointed investors this week. JP Morgan and Wells both surpassed expectations for Q4 adjusted earnings per share, but revenue missed Street's views amid declines in investment banking. Citigroup, meanwhile, missed expectations on both the top and bottom lines. JP Morgan Chief Executive Jamie Dimon issued a warning that, quote, markets seem to be underappreciate potential hazards, including from complex geopolitical conditions, the risk of sticky inflation and elevated asset prices, end quote. The financial sector had the largest percentage drop of the week last week, falling 2.3%, followed by a 2% decline in consumer discretionary and a 1.5% slip in communication services. Healthcare and technology also edged lower. In the financial sector, Wells Fargo was among the top decliners with a 7.9% loss amid its weaker than expected Q4 revenue. Wells Fargo fourth quarter corporate investment banking revenue edged up to $4.62 billion from $4.61 billion in the prior year quarter, but was weighed down by a 7% decline in investment banking, so that's why it was selling off. Then chip manufacturers and banks led a rebound. Okay, so it was kind of rough at the start, and then it led a rebound, recouping most of the week's losses. So cruise operators were among the hardest hit stocks in the consumer discretionary sector, with Royal Caribbean shares falling 11% and Norwegian Cruise Lines and Carnival slipping 10% each. On the upside, though, real estate did go up by 4.1%, followed by a 3.7% climb in consumer staples and a 3% increase in industrials. Energy, utilities, and materials also edged higher. Top gainers in real estate included shares of Crown Castle, which climbed 8.6% as the company ended its infrastructure agreement with Dish Wireless after default on payments to the company. Crown Castle exercised its right to shares to terminate the agreement and recover over $3.5 billion in payments owed. The U.S. stock market was closed on Monday for MLK or Martin Luther King holiday. Finally, if you watched the college playoff championship on Monday, it was legendary. Congratulations to Indiana Hoosiers Football program. For the first time in program history, the Indiana Hoosiers are college football national champions. The Hoosiers took down the Miami Hurricanes 27-21 in an absolute thriller to complete their undefeated season under coach Curt Cignetti. The program has officially punched its ticket as a Big Ten and national powerhouse program. Meanwhile, my Oregon Ducks, University of Oregon that is, finished their fantastic season with a 13-2 record overall, 8-1 Big Ten, with their only loss going to Indiana. All right, so where are we at for the year? Dow Jones Industrial Average is up 2.91%. NASDAQ is up 1.25%. S&P is up 1.5%. And the MSCI EFN's index is up 3.53% for the year so far. That's the 1 year trailing. Thank you, Y-Charts, for that data. 10-year Treasury is trading up around 4.24%. A month ago, it was at 4.15. 3 months ago, it was about 3.99. So we're up from there. And key economic data. Wednesday, construction spending, that's the November number, and pending home sales. Thursday, weekly jobless claims, gross domestic product, Q3, first revision, personal consumption and expenditures index, or the PCE. Friday, consumer sentiment. And then purchasers managers index, that's the PMI, services and manufacturing sector. So we'll be following that for you. This week, notable companies reporting earnings. We got Netflix, Interactive Brokers, 3M, U.S. Bank Corp on Tuesday. Wednesday, Johnson & Johnson, Charles Schwab, and Prologis. Thursday, Procter & Gamble, GE Aerospace, Intel, Abbott, Intuitive Surgical, Capital One. And so that kind of rounds out the week of notable companies. And the tax tip of the week is the tax tips for those in military. And we are approaching tax season. It's like getting into full swing here. The Internal Revenue Service has certain special tax breaks and programs for members of the U.S. Armed Forces. Earned income tax credit. You may include non-taxable combat pay as part of your taxable income, including it may boost your earned income tax credit, resulting in you owing less and potentially a larger refund. Signing joint returns. So as a rule, both spouses normally must sign a joint income tax return. If your spouse is absent due to military duty, you may be able to sign for your spouse. However, you may need a power of attorney to file a joint tax return. This information is not a substitute for individualized tax advice. Please consult your qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. All right, we got a good show for you. Stay tuned. Hey everyone, I just want to take a quick 2025 look back, 2026 look ahead. All right, so let's see. 2025 rewrote parts of the playbook. 2026 is about using it. So what changed in 2025? As a reminder, a major tax law extended many 2017 provisions and added new deductions. That's the OBBBA Act. And then we've got the SALT caps lifted temporarily. A senior bonus deduction began. Estate and gift exemptions moved to $15 million per person, indexed going forward. Trade policy and tariffs sparked early volatility, then markets found their footing. Okay, so tech and AI led those gains. Broader indexes participated. Inflation moderated from peaks, and growth actually held up. So what that means is less uncertainty on rates and deductions for now, a bigger window for lifetime gifts and multi-generational planning. Business owners got a fresh incentives to invest. But permanent can change. That quotation of permanent can change. States still matter. Concentrated markets add risk. Okay, so be mindful of that in diversifying your portfolios in the proper way, aligned with your goals and objectives. So what to watch for in 2026? Finalized trade deals and any tax sunsets. Got to watch that. Rate cuts are possible, but not promised. Housing is adjusting. Affordability is in focus. Midterm politics may boost headlines more than long-term outcomes. Moves to consider: pressure test your estate plan while exemptions are high. Review trusts like GRATs and SLATs and beneficiary designations. Time gifts of appreciated assets, and revisit charitable strategies. So if you want a tailored 2026 checklist and timeline based on your situation, we're here to help. This is Northbound Wealth Management. So if you have any questions, reach out to us. On to the next segment. If you are 50 years old or over, 50 plus, do you know how your catch-up contributions are changing? Who's affected? Employees aged 50 plus whose prior year W-2 FICA wages from the same employer exceed $150,000 indexed must make any 2026 catch-up contributions as Roth. That's after tax. That's very important. That's a change. When it applies, the statute kicks in for 2026 contributions. Final IRS regulations took effect on November 17th, 2025, and generally apply starting in 2027. For 2026, though, plans may operate under a reasonable and good faith interpretation. Number 3, what to verify. Your plan must offer a Roth source. If it doesn't, affected employees can't make catch-ups or catch-up contributions until a Roth is added. Okay, number 4, with a Roth IRA to qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and occur after age 59 and a half. Tax-free and penalty-free withdrawals can also be taken under certain other circumstances. The original Roth IRA owner is not required to take minimum annual withdrawals. With a Roth 401k, employer matching with pre-tax dollars is not distributed tax-free during retirement. All right, so if you're over 50, that's your Did You Know? So stay tuned for more Secure 2.0 updates. Stay tuned for the next segment. Is waiting until 70 a smart Social Security move? An October 2025 piece in the Wall Street Journal titled "Why Delaying Your Social Security Benefits May Not Make Sense" pointed out that delaying may not be the best fit for every household. 4 angles to consider. Number 1, behavior and cash flow. Many retirees spend income but hesitate to draw principal. Delaying can unintentionally pinch lifestyle early on when you're healthy and want to enjoy it. Number 2, market sequence risk. Bridging with larger portfolio withdrawals while you wait can raise exposure to early retirement downturns. Number 3, timing and Medicare. Timing can affect how you sequence retirement plan withdrawals and handle Medicare payments. It's called sequence of return risk, if you want to Google that and look it up. Number 4, longevity and survivor needs. Health outlook, age gap, and survivor benefit priorities can tilt the math toward earlier or later claiming. Okay. Takeaway: there's no one-size-fits-all rule. A tailored strategy that models cash flows, risk, and household goals beats a one-size-fits-all solution. So if you have specific questions about your financial situation, reach out to us or talk to your financial professionals about it. Get some advice. It helps. All right, on to the next segment. Are you supporting your adult child financially or subsidizing their lifestyle? A July 2025 article in the Wall Street Journal titled "4 Ways to Prepare for When Your Adult Kids Need Financial Help" examines how parents support their grown children without compromising their own financial stability. Set the frame before the funds. Define purpose, amount, and end date in writing. Treat it like a mini agreement. Clarity preserves relationships. So make a decision. Decide, is it a gift, loan, or guarantee? So gift is simple, but set expectations about whether it's one time or something that's ongoing. Loan would be document the terms and the repayment schedule. Automate payments like a loan, obviously. Co-signing can be the highest risk. Know that you're taking on the debt if things go sideways. So you could always do that, but you got to have the proper relationship in place and boundaries in place to make sure that you're covered. Your retirement should come first. If Help jeopardizes savings, timeline, or insurance coverage. It may be too much. Avoid open-ended support. And that just enables bad behavior, actually. Create guardrails, including milestones such as job search and budgeting courses, time limits, and a check-in date. Build skills, not dependency. Pair any money with a strategy, budget, emergency fund targets, and next steps to independence. The bottom line, thoughtful structure helps turn thought into progress and can help family dynamics healthy. All right, hopefully you found that helpful. On to the next segment. Hybrid work doesn't make sense. Would you accept a lower salary if it meant maintaining a hybrid work schedule? Stanford University in June of 2024 released a study on hybrid work called, quote, "Study Finds Hybrid Work Benefits Companies and Employees," end quote. That's worth sharing, especially for those who love or miss a flexible schedule. Here's what they found. Employees working from home 2 days a week were just as productive as those in the office full time. They were just as likely to be promoted, and they were 33% less likely to quit, with the biggest drop in turnover among women, non-managers, and those with long commutes. In other words, hybrid work didn't hurt performance. It kept people engaged and helped them stay with their companies actually longer. Many people don't have a choice about where they work, but it's still interesting to see different data points. Would you trade a little salary to keep a hybrid schedule, or does being in the office full-time feel worth it for the collaboration, energy, and routine it provides? So I'm kind of a hybrid guy, and from time to time, it's nice to have some flexibility. But I am also very old school, just personally speaking. I like to show up, be in the office, and that type of thing. So do what's best for you. And hopefully you find a job that allows you to do that in a way that is best for you. All right, on to the next segment. Hello, everybody. I came across this that I thought that I would cover, especially at the beginning of the year, about these financial strategists making predictions on the S&P 500. The source of this article is the S&P 500 closing predictions, and it's staff research. And I was able to see this. And then also I saw it posted on thestreet.com, which I thought was interesting. And I like this compilation. How market experts see S&P 500 ending in 2026. And they're often wrong, but it's interesting to look at. So let's go through this list. I'm going to say the firm or the analyst name. I'm going to say what their prediction is for S&P 500 year-end 2026 value. And then we're going to talk about what the change is. So the other column is the change from 2025. And we'll see where people's sentiment or forecasts kind of put them. Let's go through this list quickly. So Oppenheimer, if you've ever invested with them or heard about them, Oppenheimer says 8,100. That is a 17.76% increase from the ending values of December of 2025. So where the year ended last year. So that's quite the gain. But Deutsche Bank's got 8,000. That's a 16.3% increase. Morgan Stanley, 7,800 price target on the S&P with a change of up 13.4%. Wells Fargo, 7,800, same thing, 13.4. RBC Capital Markets, 7,750. That's a 12.67% gain that they expect. UBS or Global Wealth Management, 7,700. That's 11.94% estimated projection. Tom Lee at Fundstrat, he's widely followed, 7,700. That's an 11.94% increase. Ed Yardeni, also widely followed, 7,700, same, 11.94. Citigroup, same, 7,700, 11.94% gain. Goldman Sachs, 7,600. That's 10.49% on the gain, what they expect. LPL Financial, 7,540 or 7,540, 9.62% for 2026 is what they expect. FactSet, 7,501. That's a 9.05% gain. HSBC, 7,500, 9.04%. JP Morgan, 7,500, Again, 9.04. Stiefel Financial, 7,500, same. And then CFRA, 7,400 or 7.58% gain. BMO Harris Private Wealth, 7,400, 7.58%. Socio General, 7,300 or 6.13% gain. BCA Research, 7,200, 4.67% gain is what they expect. Bank of America is kind of on the lower end at 7,100 or a 3.22% gain. Ned Davis is the same at 7,100 as well. But the average of all of those price targets on the S&P 500, the average is 7,577 is what they expect the S&P to do. That is a 10.15% gain for 2026 is what they expect on the calendar year. This is always subject to change and revision. They often revise these forecasts mid-year or when things go awry and look different. And so it is a crazy game that Wall Street plays, and they put these out. But I'll tell you, it's not crazy either. None of these forecasts are completely out of the ordinary because the S&P 500 has annualized about 10% over the last 10 or 15, 20 years on an annualized basis. So not crazy. So $15 of earnings is expected for the S&P 500 this year. And so far it's off to a pretty good start. And it actually could be a decent year in the market again. Or, we'll have to see where it goes. I happen to think it's probably in line. We've had 3 really good years. This might be a flat year. It might be a negative year. It might be really, really choppy up and down, or it just might be a good year. We don't know. We'll have to see how it goes. We'll talk more market stuff over the next coming podcasts, as well as tax stuff, given that it's tax season. And I hope you guys have a great week this week and weekend, and we'll talk to you next week. Thanks for tuning in to the Northbound Wealth Podcast. We'll talk to you soon.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.